3.3 Making Sense of Financial Statements. The most striking aspect of the present state of ratio analysis is the absence of an explicit theoretical structure. The user of ratios is required to rely upon the authority of an author's experience. As a result, the subject of ratio analysis is replete with untested assertions about which ratios should be used and what their proper levels should be. James Horrigan, 1968. With the growing availability of financial statements over the past 130 years or so, people have developed ways to analyse or make sense of the information they contain. People have taken an old idea from the ancient Greeks about ratios and used this to focus on the relationship between different items in a firm's financial statements. People have sought to use these relationships, or ratios, to predict whether a firm might be likely to fail in the future, or perhaps more positively, what its earnings or other performance measures might be in the future. The only problem with this was there was no clear reason why these ratios should be useful to predict future outcomes of firms. There was no reason, no theory, no mental framework or reason connection, or in other words, no understanding, for us to think that these ways of analysing a firm's financial statements help us to meaningfully engage with the future economic and business realities of firms. In this section, we look at how people have developed approaches to analyse or make sense of financial statements. Ratios. From the late 19th century, as financial statements started to be provided more frequently to people outside of firms, they began to be more systematically analysed and assessed. Ratios were used as a key part of this analysis. They help us focus on the relationship between different items in a firm's financial statements. The term ratio, the Greek word for ratio is logos, was first introduced by Euclid in the Elements. Euclid's Elements is the world's second most widely translated and circulated book, second only to the Bible. Written in about 300 BC, it has had over 1,000 editions and is an amazing treatment of geometry and number theory. It gathers together the concepts and theorems of Greek mathematics. It is not easy to read. It contains no examples to illustrate the concepts, no clever comments, indeed not even an introduction. It contains nothing but theorems and their proofs. Nevertheless, it is without doubt the best mathematics text ever written. Book 5 of the Elements provides a thorough analysis of the properties of ratios. The earliest use of the word ratio in the Oxford English Dictionary is from Barrow's 1660 translation of Euclid's Elements. Ratio, or rate, is the mutual habitude or respect of two magnitudes of the same kind to each other according to quantity. Archibald, 1950. In his 1908 translation of Euclid's Elements, Sir Thomas Little Heath said, "A ratio is a sort of relation in respect of size between two magnitudes of the same kind." Heath, 1908. I quite like the idea of mutual habitude, which sounds a bit like two people living or flatting together and focuses on the idea of looking at the relation between two numbers or quantities. A lot of analysis of financial statements uses this mathematical idea of the Greeks to help us gain insights into the economic and business realities of firms. Just do what works. In the 1890s, it started to become more common practice for bankers to request financial statements to assess applications for credit in the US. Most bankers probably requested a balance sheet, looked over it carefully, and filed it with no attempt to systematically analyse its contents. However, some bankers appear to have started to increase the level of sophistication of their analysis. They began to separate current and non-current assets and liabilities in the balance sheet and to calculate some ratios. They began to pay attention to the current ratio, which is the relationship between current assets and current liabilities of a business. Analysing financial statements also started to become more popular for equity investors, although how they went about doing this was usually quite unformulated and unclear. In the first 20 years of the 20th century, an increasing number of ratios were being calculated and used to help assess businesses. Criteria to assess what were good or bad ratios began to be developed, including the then well-known requirement of a 2-to-1 current ratio, twice as many current assets as current liabilities. Also, the benefit of comparing a firm's ratios with the ratios of other firms was starting to become apparent. However, analysis of financial statements was still largely casual and informal, with only some people calculating and using ratios as part of their analysis. In 1919, Alexander Wall, in his classic Study of Credit Barometrics, Wall 1919, produced 7 ratios for 981 firms in the US. A barometer measures changes in atmospheric pressure to forecast the weather. Wall's ratios were meant to be like a barometer, measuring changes in a firm's past performance from its financial statements to predict its future performance. Wall's study was influential. It showed how financial statements could be analysed by calculating several different ratios for a firm and then comparing these ratios with the ratios of other firms. Influenced by this study, there was a rapid growth in the 1920s in the US in the number and type of ratios that analysts began to consider when assessing businesses. Ratios were also collected for industries and average ratios calculated for comparison purposes. In the 1930s, Roy Fulk successfully promoted a group of ratios as being the most useful, largely because he was also able to supply industry data for these ratios. In 1933, while working for Dun & Bradstreet, Fulk published his ratios, and they quickly became a well-known and widely used series of industry average ratios in the US. Fulk, 1968. With the growing dominance of the US economy, over time the emerging practices in the US greatly influenced the way financial statements were analysed in other parts of the world. Today, analysts of financial statements still may often select the ratios and information they use and the criteria they use to judge this information based on a pragmatic view of what works, drawing on the authority of experienced investors and lenders. Typically, there may not be a clear framework, conceptual map or idea in the analyst's mind that clearly links information from the financial statements to the economic and business realities of firms. In other words, they may be tending to just look at the numbers and not at how the numbers are connected to a firm's performance. There is quite a lot of consensus among practitioners and others about the usefulness of financial statement analysis to examine high-level categories of profitability, long-term solvency, and short-term solvency. Profitability, how much a firm earns, and liquidity or solvency, how readily a firm can come up with cash, if needed, are commonly thought of as useful aspects to examine of a firm's financial statements. However, once we seek to get more specific about which ratios and information from financial statements are useful, we find a diversity of views rather than consensus. These views can be seen expressed in a range of popular textbooks and other academic writings on financial statement analysis. References to some of these are at the end of this chapter. However, I do not find this approach to financial statement analysis of relying on what practitioners do to be so useful, since other than agreement on the value of looking at profitability and long-term and short-term solvency in a general sense, there is surprisingly little agreement or consensus on the details. There's also no clear reason why these various ratios should be useful to predict future economic and business outcomes of firms, and indeed no clear evidence that they are. However, we can gain a lot of practical wisdom and good sense from experienced practitioners, particularly if they combine their experience with the ability to explain and communicate their insights well. In this respect, I would recommend the classic work Security Analysis by Benjamin Graham and David Dodd, Graham and Dodd, 1940. This is a real favourite of mine. An easier to read version of this book is The Intelligent Investor by Benjamin Graham, 1949. I would also recommend the writings of one of Benjamin Graham's most famous students, Warren Buffett, such as Buffett 1984. Warren Buffett is arguably the most successful investor in the world and is one of the world's richest individuals. Many of us around the world enjoy reading Warren Buffett's annual musings based on his practical experience and sound good sense in his annual Christmas, a chairman's letter to the shareholders of Berkshire Hathaway Inc., Buffett 2021. These come out in late February or early March each year. Indeed, when the time comes for Warren Buffett to stop writing these annual letters, many of us will miss his valuable injection of views based on extensive practical experience and good thinking. The key to the success of the ideas of Benjamin Graham and David Dodd and of Warren Buffett is their ability to use financial statements and other sources of information to gain insights into the economic and business realities of firms. Use a structure. There have been some attempts to provide a framework or structure to support the practice of financial statement analysis and the usefulness of certain ratios. In about 1919, the DuPont company in the US applied the idea of analysing profit margins and asset turnovers to a major manufacturing enterprise. This idea had been used for some time in retail businesses. The DuPont company evaluated its operating performance by focusing on return on assets, which is the relationship of profit to total assets. This was broken down into profit margin, profit to sales, and asset turnover, sales to total assets. However, the DuPont company's framework for the use of ratios to analyse a firm's financial statements had little immediate influence outside the DuPont company itself, although, as we will see later, it did belatedly catch on. There were other attempts to come up with different structures. For example, in 1923, James Bliss attempted to provide a framework for the integrated use of the growing number of ratios he was using. However, his ideas generally were not taken up in practice. Bliss, 1923. In the 1950s, there were a few studies that looked at the usefulness of the DuPont approach of breaking down return on assets into profit margin and asset turnover ratios to assist decisions by business managers. This held some promise of being able to use measures of return on assets as a means of integrating several ratios into a coherent system of analysing a firm's performance. Since the 1950s, the DuPont approach started to gain a degree of popularity. We'll see in section 4.4 in Chapter 4 that we will draw on aspects of the now well-known DuPont approach. When we analyse our firm's financial statements, we should not simply focus on a firm's financial statements. Instead, we should use a firm's financial statements to help us engage with key aspects of our firm's economic and business realities. We need to use a firm's financial statements to help us understand these realities and to then quantify the dollar effects they may have on the value of a firm. A firm's economic and business realities are messy and qualitative in nature. For example, key aspects of the economic and business realities of Ryman Healthcare might include the level of residential house prices in New Zealand and the proportion of the population over 75 years that wish to live in retirement villages. We might be able to find various statistics or numbers on these two aspects of Ryman Healthcare's economic and business realities. and make some predictions about them. But how do we connect these insights into value for the equity investors in Ryman Healthcare? This is where analysis of financial statements can come in. An analysis of a firm's financial statements can help us gain an understanding of the quantified dollar effects of Ryman Healthcare's economic and business realities. It can do this if we understand the connections between the key drivers of Ryman Healthcare's economic and business realities and the key drivers of its financial statements. What we need is a theory of financial statement analysis that will help us connect a firm's financial statements with its economic and business realities and to its value. The focus of our analysis of our firm's financial statements should be on understanding the connections and relationships between key elements of the financial statements and the key drivers of the economic and business realities of a firm. This leads us to focus on understanding the economic and business drivers of a firm, which is at the heart of making sense of what our firm's financial statements can tell us. Let us now consider how we know what anything is worth to us in the world of business, and how this might help provide a framework or theory for us to analyse a firm's financial statements. 3.4. The value of anything. Price is what you pay. Value is what you get. Warren Buffett. What is something worth to us? The only way we know how to value anything in business is to put a value on the future cash flow we expect from it. We do this by calculating a present value of its expected future cash flow. This is the value today of the cash flow we expect to get in the future. Here is $20. There is a picture of John Flynn of Royal Flying Doctor Service fame on one side and a picture of Mary Reeby of Convict Made Good fame on the other. Would you like this $20 note now? Or perhaps you would prefer I gave it to you in 5 years' time? The fact most people would say, I would prefer the money now please, means that dollars today are generally worth more to us than the same amount of money in the future. For this reason, we reduce or discount the value of money we might expect to get in the future to its present value to us today. This is what present value, often shortened to PV, means. In this section, we'll see that dividends are what equity investors expect to receive in the future from their investment in companies. It is in fact all they will ever receive from a firm by owning shares in it. We will also see how the cash flow generated by a business is directly related to dividends. So when analysing firms, we can focus on a firm's cash flow instead of on its dividends. Dividends. The only way we know how to value any asset or business is to value it based on the cash flow we expect to gain from it in the future. The more cash flow we expect to get in the future, the higher its value. The less cash flow we expect, the lower its value to us. What cash flow do we get from owning shares in a company? Well, the only cash flow equity investors will get from their investment in the shares of a firm is a stream of future dividends for the rest of the life of the firm. If the firm is liquidated or taken over at the end of its life, this would include a final dividend. This final dividend would represent the remaining assets after all liabilities of the firm have been settled, or a payment to the equity investors from the party taking over the firm. That is what an equity interest entitles you to, nothing more and nothing less. If we sell our shares to someone else, as we often do as equity investors, rather than hold them for the full life of a firm, someone will pay us money for those shares. So we might make a capital gain or loss when we do this, which could be quite significant. But what does the person buying the shares from us get from owning them into the future? Well, the dividends they expect to get into the future. Dividends, and only dividends, are what a share gives us, regardless of how its share price may fluctuate over time. This means the equity value of a firm is the present value, PV, of expected future dividends. Equity value equals PV of expected future dividends. This is called the discounted dividend DD model. It is the theoretical basis for us to value equity in a firm. We forecast the dividends we expect to receive and discount them to the present by applying a suitable discount rate. We discount or reduce future dividends to reflect the fact we generally prefer money in our pocket today rather than money we might expect to receive in the future. This is the value to us today of owning equity in a firm. If we could in practice value equity using this approach, equity investors would focus on using the financial statements and other sources of information to predict a firm's future dividends. Though dividends are what equity investors in a firm will get, they are generally not able to be used in practice to value equity in a firm. The key difficulty is that dividends are not the source of value for equity investors. Rather, they are simply a transfer of value between a firm and its equity investors. To see what I mean, let us look at the forecast dividends for two firms, King Enterprises and Marks Inc. Both companies have a policy of distributing 10% of their profits each year. Table 3.1, Forecast Dividends. King Enterprises and Marks Inc. Year 1, Year 2, Year 3, Year 4. Each company has the same forecast dividends, 1,000 Year 1, 1,100 Year 2, 1,200 Year 3, 1,300 Year 4. Which company would you prefer to own shares in? Well, you might say you do not care. You would value each company the same. After all, the expected dividends from each company are the same. Let us now say that Marks Inc. decides to increase its dividend payout ratio, the proportion of its earnings it pays as dividends to its shareholders, from 10% to 90% of earnings. Assuming no change to earnings, this would result in dividends from Marks Inc. increasing by 9 times as follows. Table 3.2, Forecast Dividends. Marks Inc. changes its dividend policy. Year 1, Year 2, Year 3, Year 4. King Enterprises, 1,000, 1,100, 1,200, 1,300. Marks Inc., 9,000, 9,900, 10,800, 11,700. Which company would you prefer to invest in now? Does it mean my equity in Marks Inc. is now worth 9 times more than it was prior to the change in dividend policy? This does not seem to make much sense. Nothing has necessarily changed concerning the economic and business realities Marks Inc. is facing, such as the market for its products and services, the actions of competitors, government regulation and taxation. Everything about its actual business is still the same. The only thing that has changed is that the board of directors of the firm has held a meeting and decided to increase the proportion of profits it pays to equity investors as dividends. It is not obvious how this action by itself can change the value of a firm. This is the key practical difficulty of valuing equity in a firm using a discounted dividend DD model. It is difficult to forecast a firm's future dividend policy to the end of a firm's life, as it is based on the discretion of a firm's management and board of directors. As well as the regular payment of cash dividends, a firm will typically have other transactions between itself and its equity investors. These will include the issue of new shares and share buybacks, the repurchase by a firm of its shares from equity investors. To understand the value of the equity of a firm in practice, we will need to look in behind the dividends a firm pays its equity investors. One way to do this is to focus on the cash flow a firm generates from its operating activities. In the virtual world of our firm called accounting, dividends and cash flow are related. Their relationship can be expressed like this. Dividends D equals operating cash flow C minus capital outlays I plus net cash flow from debt owners F, that is D equals C minus I plus F. Remember, our idea of dividends is net dividends, which are the net payments to equity investors in a firm. It includes all transactions between a firm and its equity investors. Operating cash flow C is the cash generated by a firm's operating activities from selling goods and services, less the expenses incurred in generating those sales. For example, the operating cash flow C of Tanby Rose's florist in Yeppoon might include cash received from selling flowers and related items to customers, such as $50 for a bouquet of roses, less expenses such as the cost of flowers and other items sold, rent, salaries of staff, advertising, electricity, insurance, and maintaining its website. Capital outlays I is the cash invested into the operating assets of a firm. These are the assets that generate products or services for sale, less the cash received from selling operating assets. For example, Tanby Rose's florist might invest in a new fit-out for its store with new signs, shelving and furniture. It might also increase its inventory into new lines of gift and related items. It might also receive some cash from selling some of its old shelving and furniture, and perhaps from selling an old delivery van it no longer needs. For other businesses, capital outlays I might include investing in new factories, new retirement villages in the case of Ryman Healthcare, corporate jets, additional inventory, or a new warehouse. Less what might be received from selling operating assets, such as some surplus land or an old factory. The operating cash flow C, for example from selling flowers, less capital outlays I, for example installing a new shop fit-out, is known as free cash flow, FCF. This is the cash flow that is free of the operations of the business. It is the cash being generated by the business after allowing for ongoing capital investment into its operations. So FCF, free cash flow, equals C minus I. We use the letter I to represent capital outlays because it is the net cash investment into a firm's operating assets. And C is already taken, being used to represent operating cash flow. As FCF equals C minus I, we could change our relationship of dividends and cash flow from D equals C minus I plus F to D equals FCF, free cash flow, plus F. The term cash flow is often used to refer to several different things. Cash flow can refer to operating cash flow C, which is the cash generated by the operations of a business without allowing for ongoing capital investment into the business, to free cash flow, FCF, the cash generated by a business after allowing for ongoing capital investment, or to various earnings-based measures used to approximate cash flow, such as EBITDA. EBITDA is a short way of saying earnings before interest, tax, depreciation and amortization, which is quite a mouthful. In this study guide, when using the words cash flow, we will mean free cash flow, FCF. If a firm had no debt or borrowings, it would have no net cash flow from debt owners, F, and so F would equal 0. We can see from our relationship between dividends and free cash flow, D equals FCF, free cash flow plus F, that if this was the case, dividends, that is the net cash flow between a firm and its equity investors, would simply equal a firm's free cash flow, that is its operating cash flow less capital outlays. However, usually a firm does have some borrowings, or alternatively some spare cash reserves it does not need in its business, which it lends to others, such as putting it in the bank. In 2021, Ryman Healthcare paid its equity investors a dividend of $107.5 million in cash and bought back $3.0 million of its shares to give a total dividend or net transfers between a firm and its equity investors of $110.5 million. The equity investors who received this dividend included my 3 children as well as one of the Maori iwi or tribe's Ngāi Tahu. However, its free cash flow, FCF, in 2021 was negative $435.2 million. So how did Ryman Healthcare pay a dividend, that is net cash flow to its equity investors, of $110.5 million if it had negative free cash flow from its activities that year of $435.2 million? Where did the cash of $110.5 million come from to pay my children and the other equity investors their dividends? It came from Ryman Healthcare borrowing from its bankers. Since there is a relationship between a firm's dividends, its net cash payments to its equity investors, and its free cash flow, FCF, we can focus on the free cash flow, FCF, of a business instead of on dividends when seeking to form a view about the value of our equity investments in a firm. Conclusion. In this chapter, we have seen there are two key financial statements businesses prepare: the balance sheet and the income statement. The balance sheet shows the assets, liabilities and equity of a firm on a day. The income statement shows a firm's revenue and expenses for a period, usually a year. These two financial statements set out the 5 elements of accounting, which we can express as assets plus expenses equals equity plus revenue plus liabilities. We also saw how the income statement and balance sheet are interconnected. The bottom line of the income statement, which is a firm's profit or loss for a period, is included in a firm's equity in the balance sheet at the end of the period. There are 2 other financial statements: a statement of changes in equity, which shows how equity has changed during a period, and a statement of cash flows, which shows how cash has changed during a period. Both statements are also interconnected with a firm's balance sheet, showing details about how 2 key items in a balance sheet, equity and cash, changed during a period. With the growing availability of general purpose financial statements, we saw that people began to develop ways of using them to help them engage with the economic and business realities of firms. A key approach that quickly developed was to calculate various ratios, which give the relationship between 2 or more items in a firm's financial statements. We discussed how the value of an equity investment in a firm is the present value, PV, today of the expected future dividends of a firm, and that it is based on expectations about an uncertain future, which rarely happens exactly as people expect. We also saw we can look at the free cash flow, FCF, of a business instead of its dividends when we seek to value the equity in a firm, and that we will often simply use the term cash flow to refer to free cash flow, FCF. In the next chapter, we will consider how we can analyse a firm's financial statements to help us engage with and understand a firm's economic and business realities. We will consider the concepts of cash flow and economic profit, and will see the value of restating a firm's financial statements to clearly separate a firm's operating and financial activities. We will also look at how we can analyse or break into bits key aspects of a firm's financial statements to possibly help us better understand a firm's economic and business realities.